bag. This is Accounting is a Joke, where accounting makes sense so you can make dollars. Today we're going to take a look at a walkthrough illustration of how to properly adjust certain transactions and record the subsequent events that take place from the previous adjusted entries. So if you're unfamiliar with adjusted entries, don't fret, gang. I dropped a link to a video that'll get you up to speed in no time. With that being said, let's rock and roll. So it tells us that Laughter Landscape has collected the following data for December 31st adjusted entry. So let's check out that data. All right, so it gives us, I don't know, it's a lot of stuff, right? Okay, cool. Then it says, journalize the adjusted entry recorded on December 31st for each of the items. Assume that the recorded adjusted entry is only at the end of the year. Okay, easy breezy, gang. So let's get to it. Each Friday, Laughter pays employees for the current week's work. The amount of the weekly payroll is $8,000 for a 5-day work week. December 31st falls on a Tuesday. Laughter will pay its employees on January 3rd. A lot of information, gang. So let's pull out the keywords of this. Pays employees for the current week's work. 5-day work week of a weekly payroll of $8,000. But December 31st, which is today, falls on a Tuesday, gang. That's what we need for the December 31st proper journal entry. So we should know this by now. We're dealing with salaries, and salaries is an expense to the company. And since this particular weekly payroll ends at the end of the year on a Tuesday, we have some salaries expenses that has happened, but the company hasn't paid it yet. So that's what we're doing. We're accruing for salaries right now, gang. So it's a weekly payroll, 5-day work week. So we're going to assume from Monday through Friday, and that's a total of $8,000. However, today falls on a Tuesday. And we also know that they get paid at the end of the week on Friday, which means that we have for this particular week, year end, 2 days of salaries that has happened, but the company hasn't paid. And since we need to record that at the end of the year, we're going to make the proper journal entry. We're going to debit salaries expense, and we're going to credit salaries payable. Now, gang, we should know how to properly calculate this. We're going to take the total amount, which is $8,000, multiply it times the days in which is owed, which happens to be 2, Monday, Tuesday, divided by the total work week, which we know of 5 days. So that's going to give us an amount of $3,200. And of course, that would be to accrue salaries expense. We're going to check the answer. Nice work, gang. Moving on. On January 1st, the current year, Laughter purchased an insurance policy that covers 2 years of $8,000. All right, gang, what are the keywords with this? January 1st, current year, made a purchase of insurance policy for $8,000 that represents 2 years. So what are they saying? At the beginning of this previous year on January 1st, the company paid for some insurance in advance. We know, gang, that this is a perfect illustration of a prepaid. So what happened is, it is now year end, December 31st, and we have to adjust that prepaid. And we know how to adjust the prepaids carefully. We have to lower the actual asset while increasing the expense that happened through that time. So the proper transaction will be a debit to insurance expense and a credit to the prepaid insurance. Now, we also have to get the right number, gang. Based on the keywords, we know that $8,000 was the total, but that represented 2 years. How much time has properly passed? Half of that. How do we know? Because it started on January 1st and it is now December 31st, which represents a complete 12 months. So what we do is we take the $8,000, multiply it times the time that has passed, which happens to be 12 months, gang, and divide it by the total amount of time that was prepaid, which was initially 24 months. And obviously that's half of the 8,000, which will bring us to 4. Record insurance expense. We're going to check the answer. Excellent job, gang. Moving on. Next, it tells us the beginning balance of office supplies was $4,300. During the year, Laughter purchased office supplies of $5,600. At December 31st, the office supplies on hand was $1,500. A lot of information, gang. Let's attack it strategically by identifying the keywords. So, quick tip. Anytime you get a transaction, it has a bunch of numbers going on that's affecting that particular account, always whip out the T accounts, gang. Actually, when I mean whip it out, I mean draw one so you can see what is actually being affected. So, keywords, beginning balance, 4,300. So that's what we started out with, gang. But throughout the period, we made additional purchases of 5,600, obviously increasing our balance of office supplies. But at year end, December 31st, it said that office supplies on hand, that's the keyword, gang, on hand is $1,500. So what is that telling us? We started out with an amount, we made more purchases to increase the total balance, but at the end of the year, we had another amount remaining on hand. So just like prepaids, we know office supplies must be adjusted based on the amount used up, which means that's what we have to calculate. We have to find out how much based on what we started out with versus what we have left we've used up. So we could use a formula. We're going to take the beginning balance plus the purchases and subtract the ending balance, the amount that we have on hand, and that will totally give us the correct amount. But we know the journal entry, gang. We're going to debit supplies expense and credit supplies. And so if we take the beginning balance of 4,300 plus the purchases of 5,600 and subtract the amount on hand of 1,500, that will give us an amount used up of 8,400. So we're going to go ahead and plug that amount in. Check the answer. Well done, gang. Moving on. Next, it tells us during December, Laughter designed a landscape plan and a client prepaid $6,500. Laughter recorded this amount as unearned revenue. The job will take several months to complete, and Laughter estimates that the company has earned 40% during this year. A lot of keywords, gang. What's really going on with this, right? The client prepaid $6,500 this year for services to be provided in the future. We know that this is a perfect example of an unearned revenue. Why? Because unearned revenues are liabilities that's created anytime the company receives cash in advance for a future service. So, to adjust this particular transaction, we understand that based on the estimates, 40% of the revenue has been earned year in, meaning that we no longer owe the initial amount of the liability. Therefore, we must reduce our liability amount, our unearned amount, by 40% while simultaneously recording the revenue earned by 40%. So what journal transaction constitutes this? A debit to unearned revenue and a credit to service revenue. And how will we calculate the correct amount? We're going to take the total initial amount, which was $6,500, and multiply it times the 40%. And that should give us $2,600. We're going to check the answer. Nice work, gang. Moving on. At December 31st, Laughter had earned $3,000 for landscape services completed for Turnkey Appliance. Turnkey has stated that they will pay later on January 10th. So, we provided a service, but we didn't get paid yet. What does this constitute? An accrued revenue. How do we know? Because by definition, we know that accrued revenues are revenues that's been earned, but haven't received the cash. Therefore, we're going to debit accounts receivable and credit the service revenue for the $3,000. Nice work, gang. Next, depreciation. Now, what I love about depreciation, I almost don't have to read the entire sentence because we already know anytime you depreciate an asset, you're going to debit depreciation expense and a credit cumulative depreciation. All we need to know is what type of assets they are and the amount. So as we can see, we depreciated equipment and trucks for $3,000 and $2,200 respectively. So we're going to debit depreciation expense for the equipment and the truck. We're going to make a compound entry, and we're going to credit accumulated depreciation for the equipment and the truck as well for the correct amounts. We're going to check the answer. Excellent job, gang. Next, Laughter has incurred $250 of interest expense on a $550 interest payment due on January 15. So, interest expense, we're talking about accrued expenses. Some interest that has happened, but we haven't paid it yet. So, we know how to record that. We're going to debit interest expense and credit interest payable. For what amount? The amount that has incurred, i.e. happened, the $250. We're going to check the answer. Excellent job, gang. So now that we've properly recorded the adjusted interest for year end, we are going to record the subsequent events that take place the following year. Some of these adjusted entries will have subsequent events that will actually relate to that in the following year. And so only those will be the ones that we're going to make the proper entries for. So if we remember from letter A, we had some accrued salaries expenses that was recorded for 2 days of work weeks, right? So now they want us to record the actual payment of that work week that follows the next year, January 3rd. So how are we going to do that? Very easy, gang. First, we have to recognize that certain accounts must be removed from the books that were previously established in the previous year end. What accounts am I referring to? I'm referring to salaries payable that was accrued for the 2 days. Remember, gang, we recorded salaries payable for 2 days, which equaled $3,200. And so now that we're making a payment for this entire work week, we no longer owe. So that liability must be eliminated. So what we're going to do is we're going to debit salaries payable for the $3,200. We also have to credit cash because we're making a payment, gang. So what will be the cash amount? Obviously the full work week. So we're going to debit cash for the full work week of $8,000. Easy breezy. However, we're not completely finished yet, gang, because we know our debits and credits aren't equaling. We have to recognize the expense that has happened for this current year, which constitute 3 work days, Wednesday through Friday. Remember, gang, they get paid on Friday. So we have to recognize that expense. So we're going to debit salaries expense for those 3 days. And how are we going to calculate that? We're going to take the total amount, $8,000, multiply times the 3 days, divided by the 5. And that should give us $4,800. Now, gang, we know most of the time when our debits aren't equal to our credits, we can subtract the difference and just plug that number in. But, hey, we like to calculate things in here. We're going to check the answer. Fantastic, gang. Moving on. In letter D, it told us that initially we had an unearned revenue of $6,500, of which year-end revenues will earn the 40% of that. And so now we're in the current year, the subsequent year, and so we're going to recognize the remaining 60% that has been earned in this year. So how are we going to record that? Simple, gang. We're going to continue to decrease our liabilities unearned revenue while increasing our service revenue for the 60%. So we're going to debit unearned service revenue and credit service revenue for the 60% of $6,500, which will give us $3,900. We're going to check our answer. Well done, gang. Moving on. Letter G told us that we had to accrue some interest expense for the previous year that hasn't been paid. Now we're in the subsequent year, which means that we're going to pay on that interest. So just like salaries, we are going to finish this situation of actually making the payment, which means that our initial accrued liability, our interest payable, needs to come off the books, while at the same time recognizing the interest expense that has happened in this current period. So what are we going to do? We're going to debit interest expense for the amount of interest that happened in this current year. We're going to reduce our interest payable for the previous recorded amount, and we are going to credit cash for the total amount of interest that was earned. And so we know our total amount of the interest payment was $550, and we know our previous interest payment recorded last year was $250. And we also know that the interest expense that has happened this year is the remaining $300. How do we know? Because the total amount was $550 and $250 had happened in the previous year. So if we subtract the 2, that gives us a $300. We're going to check the answer. Excellent, gang. So there you have it, gang. A quick, easy illustration of how to properly record adjusted entries, as well as record the subsequent events that take place the next year. If you learned anything from this particular video, please smash the like button, subscribe to the channel, and share with your friends so they can chase the bag as well. As always, gang, I'm Dr. Who, and it's my humble pleasure to have you spend your time with me because I really appreciate that, and I'll see you soon. Bags!